Hello viewers, welcome to the lecture series on financial accounting. Today in this lecture, we shall discuss in detail accounting standards. Under today's lecture, we shall learn in detail accounting standard 4, accounting standard 5 and accounting standard 6. We shall learn in detail the recognition criteria, measurement criteria and the disclosure criteria under all these standards. We shall also learn how the financial statements are being prepared in the light of the provisions being given under these standards. So, first of all, we will take accounting standard 4, which deals with contingencies and events occurring after the balance sheet dates. Then we will discuss in detail accounting standard 5, which is net profit or loss for the period, prior period item and change in the accounting policy. We shall also learn accounting standard 6, that is depreciation accounting.
Ma'am, what does accounting standard 4 deal with?
Accounting standard 4 deals with contingencies and events occurring after balance sheet date. But there is one more accounting standard, that is accounting standard 29. So, pursuant to accounting standard 29, the aspect relating to contingent assets and contingent liability has been shifted over to accounting standard 29, while for the rest of the items we are dealing with accounting standard 4. So, let us have a look at accounting standard 4. Its heading is contingencies and events occurring after balance sheet date. So, I have already told you that accounting standard 29 has withdrawn certain aspects of accounting standard 4 and that is relating to contingencies. But to the extent of impairment of assets which are not covered by any other accounting standard, that is where accounting standard 28 is not applicable to certain class of assets or certain class of transactions, still they will be covered under accounting standard 4. Now, what are the events which occur after balance sheet date? This definition has been given under accounting standard 4. So, first of all, we will analyze this definition and try to find out what does it mean by events occurring after balance sheet date. It says those significant events, it can be both favorable and unfavorable, that occurs between the balance sheet date and the date on which financial statements are approved by board of directors in case of company and by the corresponding approving authority in case of any other entity. So, what we have understood by this definition, that there is a time gap of two dates, one the balance sheet date and other date is the date at which the financial statements are approved or they are being finalized. So, in the case of a company, board of directors approve the balance sheet. So, whatever events have occurred between these two dates are known as events occurring after balance sheet date. Say for example, our balance sheet date is 31st March 2012, while the financial statements were approved on 30th September 2012. What has occurred during these 6 months would be falling under events occurring after balance sheet date. Say for example, on 30th August there was a fire in the factory premises. So, we need to account for this fire under events occurring after balance sheet date in the light of AS4. So, there are certain disclosure requirements or we need to do the adjustments in the assets and liability depending upon the nature of the transaction. So, further what we have done is that we have classified these transactions into parts.
Ma'am, what are the classifications of the events under accounting standard 4?
Accounting standard 4 has classified the events occurring after balance sheet date in two parts. The first events are those events which provide evidences to the conditions which were prevailing on the balance sheet date. So, it has been said that those events which provide certain evidences that this would occur, there are conditions which we know prehand or there are evidences of such conditions on the balance sheet date, they are known as events occurring after balance sheet date having certain indication. Say for example, insolvency of a customer. So, we would have been known to the conditions beforehand, that is certain estimation of the financial condition could have been known. So, such events are called, which are known as events occurring after balance sheet date showing indication. So, we need to account for such transactions by adjusting our assets and liabilities. They are classified as events 1. We have given it number 1 events, and second events are those events which occur after the balance sheet date that are indicative to the conditions which occur subsequent to the balance sheet date. There was no prior indication of such acts on the date of balance sheet. Now, what is the treatment of such events? As we have already discussed that the first type of events would require the adjustments of assets and liability. If there is a insolvency of a debtor, we need to make the provision for bad debts in relation to that debtor. While certain type of events where we do not know what settlement would be there, if there is certain litigation. So, what we need to do? We have to just go for a disclosure in the notes of accounts. So, these are the broad classification of the events under AS4 as well as its treatment. Now, there is one more aspect which is known as dividend. Dividend declared after the balance sheet date have to be adjusted in the accounts, whether we know it or not. Any final, interim, whatever dividend has been declared, it has to be adjusted in our books of accounts. So, these are the broad parameters which we have learned in detail in relation to the accounting standard 4. While contingencies we have altogether excluded, we shall learn it in detail under AS 29. Now, we shall learn ahead other accounting standards, and it is known as AS 5.
Ma'am, what does accounting standard 5 deals with?
Accounting standard 5 deals with net profit or loss for the period, prior period items and change in the accounting policies. Now, there are three aspects. First is the net profit and loss for the period. Second items are prior period items, and third is we have to account for change in the accounting policy. So, what this system ensures, what this standard ensures is a uniform classification and disclosure of certain items. Why we need this uniform classification and disclosure? Because we need to assess the profit and loss correctly on a uniform basis. The reason behind assessing profit and loss account uniformly, because we have to do the inter-firm and intra-firm comparison. When we follow accounting standard 5 to prepare our profit and loss statement or to assess the profitability of the organization, we need to adhere to the accounting treatments as has been suggested by AS 5. They generally gives us the disclosure requirement, whether certain items have to be disclosed on the face of the P&L or it needs to be given as notes to accounts. Then we have to account for prior period items. They are such items which are occurring on account of errors of omission or commission. So, distinctively we have to show them and have to give its impact on the current profit statement. Similarly, any change in the accounting policy has also to be accounted for and separately disclosed in our P&L account. We will discuss in detail where we need to do the disclosures or restatement of our accounting statements in relation to change in accounting policies. So, moving ahead, we shall learn first of all certain definitions which are important under AS 5. First one is ordinary activities. Ordinary activities have to be disclosed as regularly we prepare the balance sheet. So, whatever items which are necessary for running the business are ordinary activities, and they are incidental activities which are to be taken by an enterprise so that they can run on their business. So, it has been defined as ordinary activities are activities and incidental activities which are undertaken by an enterprise as a part of its business, that is running expenses, maintaining expenses, they shall cover under ordinary expenses and they have to be shown on the face of profit and loss account. Next one is extraordinary item. By extraordinary item we mean that such incomes or expenses that arise from non-recurring events and transactions. For example, there is loss by earthquake. Earthquake has occurred and it is non-recurring. It is sudden. So, whatever loss we are facing because of the earthquake is an extraordinary item. So, we have to give its impact on the P&L account separately, showing that such item is a non-recurring item and it is on account of extraordinary loss or income. Similarly, there are prior period items. Now, prior period items are defined under AS5 as incomes or expenses which arise in the current period. They have arisen in the current period, but they have resulted as a result of errors or omission in the preparation of financial statements of one or more prior periods. What do we mean by it? So, for example, there were certain salaries which were outstanding for the last year. We have to pay it in the current period. So, they are prior period items. Basically, all outstanding expenses, prepaid expenses or any other accrual basis adjustments which we are making or any rectification of errors we are doing, they are known as prior period items. So, we need to account for such items so that we can assess our profit statement correctly. Now, next item is accounting policies. Accounting policies have to be understood in a very clear manner so that we can assess how the change in the accounting policy has to be accounted for in our profit and loss statements and financial statements. So, how the accounting policies are being defined under AS5? It says that accounting policies are specific accounting principles and the methods of applying those principles in the preparation and presentation of financial statements. So, by accounting policies, we can say that they are the guideposts we need to follow so that we can prepare our accounting statements in a proper manner. They can disclose true and fair view of the organization. Like depreciation is an accounting policy. We need to follow depreciation accounting and the methods so suggested by depreciation. So, it is one of the accounting policies we have to take into consideration for preparation of our financial statement. Similarly, valuation of inventory, it is being done at cost or net realizable value, whichever is lower. So, the valuation of inventory is done as per the policy so framed by the management and as per the guidelines being given under accounting standard 2. Sometimes there are guidance notes which are being issued by Institute of Chartered Accountant of India which suggest proper accounting of any transaction, as sandweight credit rules are there, how moderate accounting is to be done. They need to be taken into consideration for doing the proper accounting. So, accounting policy is the most significant part while formulating the financial statements. Similarly, there are provisions for taxation. AS 22 deals with the taxation accounting, where we have to make the provision of deferred tax assets and deferred tax liabilities on account of any timing difference or permanent difference arising because of depreciation or other expenditure which are being allowable or disallowable. So, these accounting policies have to be adhered and understood so that we can finalize our financial statements in a much better manner. So, this was accounting standard 5. Now, let us see what are the disclosure requirements under accounting standard 5. First of all, extraordinary items. Let us understand how we need to show its disclosure. The nature and the amount of each extraordinary item should be disclosed separately because it is a non-recurring item and we have to show in our P&L statements properly and separately so that its impact on current profit and loss can be perceived and we can account for it in a distinct manner. Next one is ordinary items. Ordinary items, as we have already discussed, that they are the items or they are the activities necessary for an undertaking so that it can carry on its business. So, what are the disclosure requirements of such ordinary items? When items of income and expense from ordinary activities are of such size, nature and incidence that their disclosure is relevant to explain the performance of the enterprise for the period, the nature and amount of such items should be disclosed separately. For example, there is certain expenditure which is very crucial, or the amount is such that it needs to be disclosed separately. We have to disclose that item in a distinct heading. We cannot give a heading like miscellaneous expenses or office expenses if its nature is such that it has to be disclosed separately in the P&L. For example, personal expenses, so salaries to the staff, other welfare benefits which we are giving to the staff have to be disclosed under one head. So, these are the ordinary items which need to be disclosed properly as per their size, nature and incidence. Now, next one is accounting estimates. There is a big difference between accounting estimates and accounting policies. Let us understand what do we mean by accounting estimates. Accounting estimates have been defined under AS5 in this manner. The nature and the amount of change in an accounting estimate which has a material effect in the current period or which is expected to have a material effect in the subsequent periods should be disclosed. If the effect cannot be quantified, this fact should be disclosed. Next one is accounting policy. The effect of any change in accounting policy, if material, should be disclosed in the financial statement of the period, quantifying the impact. Where the effect cannot be quantified wholly or in part, the fact should be disclosed, meaning thereby that wherever there is change in accounting estimates, we need to do the disclosure in the form of a note, and if it cannot be quantified, again it has to be disclosed. While accounting policies change has to be disclosed in the P&L. For example, earlier we were following the accounting policy of depreciation and we are depreciating the assets on WDV method. Now, we have shifted to SLM method. So, this change on account of depreciation policy have to be disclosed with the impact of such change on the profit and loss account. Next one is accounting standard 6. We have already covered up accounting standard 5 in detail. Now, we are moving ahead and we will learn how accounting standard 6 will deal with the accounting of depreciation. Now, we shall learn in detail accounting standard 6. Let us have a look at what accounting standard 6 deals with. So, there are a lot of accounting treatments accounting standard 6 is dealing. First is depreciable assets, second is depreciable amount, then estimated useful life of depreciable assets, change in depreciation policy, historical cost of depreciable assets and revaluation of depreciable asset. First of all, let us understand what this standard is suggesting or recommending us. The accounting standard 6, that is depreciation accounting, is recommending that depreciation on depreciable assets should be allocated on a systematic basis to each accounting period during the useful life of the asset. So, we can understand that depreciation has to be provided each year on a certain amount on a certain asset. So, these terms are defined in detail under this accounting standard 6.
Ma'am, what are depreciable assets?
Depreciable assets are the assets which are used for more than one accounting year. That is, for a period more than 1 year they are useful, they have limited useful life, they are not used unlimitedly. They are held by an enterprise for use in the production process or for supplies of goods and services, meaning thereby that they are not meant for resale. They are used for renting to others, it can be building, for administrative purposes, it can be fixtures and furnitures, for and not for the purpose of sale in the ordinary course of business, as I have already explained. So, we can say that depreciable assets are generally fixed assets like land and building, because it is used for a period more than 1 year. Its life is limited, but its useful life is of great number of years. and they are held by enterprises for certain production purpose, like plant and machinery is not directly being sold out, but it is used in the production process so that these supplies or goods can be manufactured with its help. So, such assets would fall under depreciable assets and we have to do its accounting. Now, why do we need to depreciate the assets? The assets are to be depreciated because as and when we use the assets, it loses its value permanently because they are being used in the process or with the passage of time, or by certain accident they may lose their value, or there can be other reasons. So, we can say that wherever we have to account for any permanent diminution in the value of such depreciable assets, we have to go for accounting called depreciation accounting. So, let us understand what do we have to depreciate, what is the depreciable amount of these assets. So, depreciable amount is that amount for which we have to do the accounting, on which the depreciation has to be charged. Now, what it shall comprise of? It is the historical cost, that is the cost at which asset was purchased, acquired. So, it is defined as depreciable amount of an asset is its historical cost or other amount substituted for historical cost in the financial statements less estimated residual value. And in simple language or in the layman language, we can say historical cost minus the residual value is the depreciable amount of the asset. Depreciable amount of a depreciable asset should be allocated on a systematic basis to each accounting period during its useful life. Now, meaning thereby that this amount has to be spread over and a certain number of years, and this number of years will be the useful life of the asset. So, with each coming year there will be certain amount which is to be written off over the P&L. So, it is a charge on the P&L account. So, particular amount is to be written in the P&L account. We have to write off such value of asset on a systematic basis. Now, let us understand how depreciation is to be assessed. So, assessment criteria has been given under accounting standard 6. It says we have to take into consideration historical cost, then expected useful life of depreciable assets and the residual value of the depreciable asset. When we take these three terms into consideration, we can derive a formula where we will write historical cost, then we will subtract residual value and divide it by the useful life of the depreciable asset, so that we can get a figure which has to be written off over the useful life of asset. Next one is methods to be followed. There are two methods we need to follow, that is known as straight line method and WDV method. And if we switch from one method to another because of certain changes in the statute or as per the requirement of any accounting policy, or there can be any reason, we cannot ad hoc go for a change unless it is being required under any law or for any compliance with the accounting standard. Where such compliance asks us to go for a change from the method of accounting, that is we are switching from SLM to WDV or from WDV to SLM, we have to recalculate the depreciation in accordance with the new method, and then we have to find out the difference of such changes, that is what is the additional depreciation we have to charge or what is the reversal of the depreciation we have to do on account of such change, and then we have to account it in the profit and loss account. So, we can say that deficiency or surplus arising from the retrospective, that is backdate recomputation, is adjusted in the P&L account in the year in which the method of depreciation is changed. If it is changed in 2010 and we are charging depreciation from 2005, so from 2005 we have to recompute the new depreciation taking the new method into account, and then the difference or surplus has to be computed. So, this is being given as the mechanism of recomputation of the changed method to be followed and its impact being given in the P&L account. Now, what are the disclosure requirements under AS 6? We have to disclose certain aspects as per accounting standard 6. In the balance sheet under asset side, we have to show the historical cost of each class of assets, that is for land and building, for plant and machinery, for furniture and fixtures. We have to separately disclose the historical cost. Then total depreciation for the period has to be accounted for. We have to prepare the schedules of depreciation, FAs has to be prepared, then a summary of the opening values, depreciation has to be written off, and then we have to present this depreciation in the P&L account. Any accumulated depreciation is there, then we have to disclose the related accumulated depreciation. If we are following the method of providing depreciation where we are using provisions or accumulated depreciation, we have to account for such accumulated depreciation separately and have to disclose it properly. Next is depreciation methods used. We have to give notes to accounts what methods we are using, whether SLM, WDV, or as per the schedule being given in the Companies Act, we are using which rates we have to specify. So, the next disclosure is depreciation rates. Only if they are different from the principal rates specified in the statute governing the enterprise, we have to disclose. If we are following the rates as has been given in the Companies Act, we need not to separately disclose that we are following the company's rate, but if other rates are being followed by the enterprises, they need to be disclosed separately in the notes to accounts forming part of balance sheet. With this, we have learned in detail the mechanism, recognition criteria of accounting standard 6 and how the assets and depreciation rates are to be disclosed under accounting standard 6. With this, we are ending up our lecture of today. In today's lecture, we have learned in detail accounting standard 4, accounting standard 5 and accounting standard 6, where we have learned how to do the accounting in relation to events occurring after balance sheet date. Then we have learned how to prepare the profit and loss account and the financial statements, taking into consideration all the recognition and disclosure and measurement criteria of net profit or loss for the period, prior period items, extraordinary items, and we have also learned in detail the difference between accounting estimates and accounting policies and how change in the accounting policies have to be accounted for in our financial statements. We have learned in detail what depreciation accounting is in the light of accounting standard 6, where we have learned what is comprised of depreciable assets, what do we mean by depreciable amount, and how the method of depreciation is to be followed, and how the impact of change in the method of accounting of depreciation will be shown in our financial statements. We have learned all the disclosure requirements of depreciation, that is how the assets of each class has to be shown in the books of accounts while preparing our financial statements, what rates are being specified, what methods we are following. So, with this we are ending up our lecture of today. Thank you.